There are too many approaches for analyzing financial charts, such as bars, candles, lines. In this video, I will discuss the most efficient one, which is Heikin Ashi. Heikin Ashi charts developed by Munehisa Humma in 1700s, and the word means average bar. The Heikin Ashi technique averages price data to ease the analysis of the chart and help us to get better understanding about the trend and future price of markets. There is a specific formula for calculating Heikin Ashi candles. The opening price of Heikin Ashi candles equals to opening price of previous candle plus its closing price divided by 2. Also, the closing price of Heikin Ashi candles equals to sum of opening, closing, highest and lowest points of current candle divided by 4. By applying these two average techniques, the overall picture of chart will be easier to understand. So I bring both Candlestick and Heikin Ashi charts from a same market to see the difference. For example, this Candlestick chart is from gold market, and as you can see, red and green candles are everywhere, and it is a little bit confusing for beginners to understand the chart. But when we switch to Heikin Ashi chart, we can see that chart seems to be more organized. For example, when the chart is uptrend, most of candles are green, and also most of green candles have upper shadow. Also, when the chart is downtrend, most of candles are red and most of them have lower shadow. Overall, this clear image can be really helpful in analyzing financial markets because it is so easy to find out when market is uptrend or downtrend. Additionally, it is so essential to know about how to read Heikin Ashi candles. Overall, candles in Heikin Ashi have three types. First type is bearish candles. These candles have a big red body and long lower shadow and a small upper shadow. Second type is bullish candles. These candles have big green body and long upper shadow and a small lower shadow. Third type is doji candles. These candles have a small body and big upper and lower shadows. Additionally, these candles indicate that there is an uncertainty in the market and traders cannot decide about their next moves and predict the future price of market. After learning about candles types, it is so essential to know about structure patterns of Heikin Ashi charts. First pattern is a strong uptrend. As you can see, bodies of candles are getting bigger, and it proves that market is bullish and buyers are stronger than sellers. It is best time to go for long position. Second pattern is weak uptrend. In this situation, as you can see, size of bodies is shrinking and small lower shadows are appearing gradually. These signs are telling that strong buyers are exiting gradually and there is a high chance of trend reversal. Third pattern is sideways trend. This area is compromised from several doji candles with red or green bodies, and this illustrates that there is an uncertainty in the market and traders cannot decide about their next moves. Fourth pattern is a strong downtrend. In this position, red candles are getting bigger and it indicates that sellers are really stronger than buyers, and also it is the best time to go for short position, and overall picture of market is bearish. Fifth pattern is weak downtrend. In this situation, bodies of red candles are shrinking and upper shadows start to appear gradually. Moreover, I brought you several examples and instances from different markets to grasp information about how to use Heikin Ashi charts for analyzing financial markets completely. This is the first example from Bitcoin market, and I want to show you how to use Heikin Ashi candles for analyzing financial charts. At first, we can see that there is a downtrend, and after looking closer, we can see that the body of candles are getting bigger in this position of chart, and the lower shadows are so long. It means that this is a strong downtrend. And also, if the price is coming in this position, we can see that the body of red candles are shrinking, and also small upper shadows are gradually appearing, and it means that this is a weak downtrend. And also, these two doji candles show that this is a sideways trend, and there is an uncertainty in the market, and traders cannot decide about their next moves. And after that, there is a uptrend, and as you can see, the body of candles are not getting too much bigger, and the upper shadows are not too long. It means that this is a weak uptrend. And after that, we can see a long upper shadow, lower shadow doji candle. As I mentioned earlier, when we see doji candles are candles with a small body and long upper shadow and lower shadow. When we see these type of candles, we should be aware that there might be a trend reversal, and also traders are not sure about their next moves. We can see that after this doji candle, the trend has changed from uptrend to downtrend. And in this downtrend, we can see that the red candles are shrinking. So it means that this is a weak downtrend. And also, we can see that, for example, in this candle, uh, the small upper shadows are gradually appearing. And after that, there is three doji candles. And as I mentioned earlier, it is not essential that the doji candles should be green or red. No, it's not matter. The doji candles body can be red or green. And the most important thing about the doji candles is their body should be small, and they should have a long upper shadow and lower shadow. And we can see that after these three doji candles, the trend has changed from downtrend to uptrend. And we can see that at first this uptrend was strong because the body of green candles are getting bigger, and also they have a long upper shadow. And also, when the market arrives in this area, we can see that there is a three doji candles with small bodies and long upper shadow and lower shadow, which means that now in the market there is an uncertainty, and traders cannot decide it is a buying time or a selling time. And also, at this position, buyers or sellers are not stronger than each other, and we should be and we should wait for next candle to decide about the market's next move. As I mentioned in my all videos, trading is so similar to mathematics, and if you want to become a professional trader, it is so essential to know about that. Just memorizing some facts and information about trade cannot help you a lot. And if you want to enter a market by just simple information, you should not expect to make profit. For example, in mathematics, if you want to become a professional and expert mathematician, you should rehearse and practice a lot, and you should solve a lot of problem if you want to memorize and comprehend all of formula. And in trade, there is a lot of information. There is tons of information from different aspects, from for example ICT or support and resistance, and for example candlesticks, price action, and candlestick patterns. There is massive amount of information and techniques and strategies in trading, the important thing is that you should practice and rehearse these strategies in real time examples if you want to become a professional trader. And you should go for reading charts and analyze charts and try to, for example, find the support and resistance zone and for example, find the FVG or order block. For example, in this chart, if you want to find the support and resistance zone, you should be aware that the place that after that most of buyers enter the market and the chart has become to increase the price is the demand zone. For example, this chart, this let me use the rectangle. For example, in this chart, this area is approximately our demand zone, because whenever the candles are uh, coming to this area, we can see that buyers are entering the market and the price will increase after that. Thanks for watching the video, hope you enjoy it, and if you have any questions related to all of trading strategies, you can easily ask me in the comment box and I will answer it as soon as possible. Hope you have a great day. Bye bye.